So, Lindsay, as you know, they're talking about removing restriction, not providing accommodation. And you can tell me if that's a distinction without a difference or not in just a moment. But ultimately, when they say recalibration, it feels like they mean autopilot on the way down to neutral. Is that the wrong way of thinking about this?
Well, I do think there's a very important distinction, and unfortunately, I think the Fed sent the wrong message with a 50 basis point cut. It was an inappropriate message to the market to suggest that they were in a rush to not only get back to neutral, but potentially below to provide support to an ailing economy, as opposed to a softer 25 basis point cut, which would have indicated that the Fed is simply removing policy firming at a slow and tempered pace back towards neutral as the data neutralize. So even if the Fed intended the latter, the message was muddled with that outsized rate reduction of 50 basis points. And now the Fed is caught in a position where they're trying to backpedal and not only recalibrate market expectations, but now determine what the appropriate next step will be after that outsized cut.
That said, Lindsay, a lot of people are looking at the growth and potential reacceleration of the U.S. economy and not seeing it get accompanied with inflation really picking up in a material way. We're not seeing that in break-even rates. We're not seeing that in a whole host of other metrics. So at what point do you actually see inflation reaccelerating in tandem with growth, given the fact that there are some reasons for inflation to keep declining?
Well, we are seeing some underlying metrics reaccelerate, push further away from the Fed's 2% target. The core PCE, for example, ticked higher. The supercore also ticked higher. But you're right, 1/10 of a percentage point is not necessarily an indication of a massive reacceleration of inflation. That being said, we're not at 2% yet. So I think the onus is still on the Fed, not necessarily to avoid a reacceleration, but to foster further improvement in inflation. The Fed's job is not yet done, and a reversion back to 2% is not a foregone conclusion. So the Fed, motivated by this fear of impending weakness in the labor market, shifted their focus away from inflation. Now we see that the labor market strength appears to be well-founded, and the focus of the Fed should go back to getting inflation under control. Remember, a soft landing is not just about maintaining positive growth, but reinstating price stability at 2%, and we still have quite a ways to go before we can achieve that goal.
This is so interesting, Lindsay, because essentially you're making the argument that maybe the Fed should take more of a page from the ECB and having more of a single mandate in terms of inflation rather than focus so much on avoiding some sort of weakening in the labor market. I just wonder how often we've seen this, where it's basically experiments on either side of the Atlantic, where one, the ECB, pledges to just focus purely on bringing inflation down, even in the face of economic weakness. And the Federal Reserve, to avoid any further weakness, says inflation's coming down, that's good enough for us, we're cutting rates.
Well, I do think that the Fed decided to move its focus away from inflation prematurely. Remember, when we look at historical cycles, the Fed has been forced to raise the Fed funds rate above, historically significantly above, that peak in inflation. So at 5.6%, 5.5% on the Fed funds rate was really the bare minimum that we should have expected in terms of this rate hike cycle. But given the massive amount of liquidity and stimulus and cash pumped into the market, it was really unreasonable to expect that the bare minimum would be the appropriate amount of policy restriction to reinstate price stability. So I do think that the Fed stopped short of where we needed to be. And now, to add fuel to the fire, they've reverted to this policy pivot prematurely before really seeing that underlying disinflationary trend take hold. And that leaves us in a very uncomfortable position as growth remains solid for now. If we do start to lose momentum looking out to 26, and the Fed continues to tolerate above target inflation, the biggest risk for the U.S. economy longer term then is not a downturn like we're seeing necessarily in our developed counterparts abroad, but a period of stagflation.
So, Lindsay, though, is there a chance if we continue to grow and we do see inflation continue to come down, even though you do have concerns about maybe a reacceleration, is there a chance we could just grow bigger and not hotter?
Absolutely. And I think that's the utopic scenario that the Fed is looking for, that we continue to see this acceleration in underlying growth, resilience in the consumer, positive spending, and positive acceleration in the labor market at the same time that price pressures begin to wane back to 2%. But again, that's a big gamble, a big bet, when we haven't seen that established downward trend in price pressures. We're still seeing very sticky components, sideways movement in the core for 1 month, that, as I mentioned, a reacceleration more recently. And we're also seeing some of these upside risks to inflation that are still hanging out there. International factors that could disrupt commodity markets and lead to higher prices, energy prices, fertilizer prices, factors that are outside of the Fed's purview, not to mention a very contentious election coming up in November. And regardless of which side of the aisle we find ourselves on, either candidate is proposing expansionary fiscal policy, which will continue to complicate the Fed's ability to get back to that 2% level of inflation.